Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Tuesday, August 12th, 2025. The Bitcoin price has started to rally. It's almost at $120,000. It's at $119,000. The gold price is down over $100 the last couple days. It's corrected. It's still up substantially over the last 4 or 5 months. It's just under 3,400 at $3,349. Today's special guest is a returning guest. He has an excellent Substack there covering macro. He's had a lot of good calls on commodities and Bitcoin. Roberto Rios, aka Peruvian Bull on financial Twitter or financial X. Thank you for joining me again.
Hey, yeah, thanks for inviting me back on. I'm happy to be here.
Yes, and what's the name of your newsletter on your Substack?
It's called Dollar Endgame. If you just look up dollarendgame.substack.com, it should pop up.
Well, we should call it fiat currency endgame because all these currencies seem to be intentionally being destroyed at this point.
Yeah, I know, right? And I've also said like the entire point of Dollar Endgame is again, that was written for U.S. investors, but we're in a fiat endgame, right? We're in the global debt super cycle, and there's serious problems faced by the Japanese and the Brits and the Europeans that will probably cause them to have much more issues even sooner than we do, although we obviously do have our fair share of problems.
Well, I was listening to a new interview with Kyle Bass in the last couple of weeks, and he was talking about how from, I think, 2020, 2023, the US money supply grew by about, I think M2 grew by about 50%. But then the point he added, because people are like, oh, the dollar's going to collapse. He said all these other countries, like the emerging markets and others, they debased their currency and grew the money supply by even more than the US. So where did all that currency and liquidity go? What, it went into gold, it went into Bitcoin, and it went into the S&P 500?
Yeah, so again, if you are a student of monetary history and you start to examine like the structure of, the post World War II order, you come to understand obviously like Triffin's dilemma and the issue of being a world reserve currency holder, which is you have to constantly export more and more currency units to the rest of the world in order for them to conduct trade, for them to settle trade balances, for them to hold as foreign exchange reserves, for them to lend and borrow with. And in the 1960s, as the U.S. started to print more dollars than was justified by their gold reserves, several world leaders, including French President Charles de Gaulle, realized that the U.S. had printed too much, and that's why they started withdrawing their gold. And by 1971, Nixon closed the gold window, right? Um, what came to replace the system after the death of Bretton Woods one was this kind of quasi petrodollar, quasi eurodollar system where the debt of the US and I guess you call it the network effect of the dollar were self-reinforcing enough to maintain dollar strength, especially after Volcker began his rate hiking cycle in 1980. And that dollar hegemony eventually led to such dollar strength that we had to have the Plaza Accords in 1985 to coordinate a devaluation of the dollar against the, four major G7 countries. And what happened in the wake of that is the US essentially became the capital pool that absorbed all the excess liquidity from the global financial system. So we would run trade deficits, a current account deficit. We'd be sending out dollars and receiving goods in compensation. And then those exporters, right? Let's say Toyota or Honda or a Malaysian palm oil exporter or Russian crude exporter, they all get dollars building up on their balance sheet. And what do they do with them? Well, it doesn't really make sense for them to sit there and not do anything, especially if you're talking about hundreds of millions or billions of dollars. The obvious thing to do is invest them into US bond and equity markets and actually get a return. And so all this capital started flowing back into US bonds and equities, which caused our something that's called our net and international investment position, NIIP, to start to move negative in the 1970s, and it moved increasingly negative, especially after 2001 when China joined the W Trade Organization and globalization started to peak. And during that time, obviously, all these foreigners were buying up all these U.S. assets, which were driving up U.S. equity prices and acting as a buoy for U.S. stocks and U.S. bonds, keeping our bond yields relatively lower compared to the rest of the world, as well as keeping our stocks much, outperforming basically the rest of the world. If you look at MSCI World Stock Index and you exclude the US, since 2008, 80% of the gains came from the US market alone. So if you exclude the US, you basically have a 4x or 5x decrease in total stock market returns. And that just shows like how concentrated the global stock market has become, especially for the US, right? All this capital just continues to get funneled back into the US, which pushes our stocks ever higher.
And the US Treasury loves this because then there's no tax receipt problem. So if the asset prices are going up, that means more capital gains taxes on the stock market for people trading stocks, people profitable with crypto trades, and people selling their home prices, flipping homes, all that stuff. Whether they're buying and holding homes or they're actually flipping homes, and that's how you have all these speculators in the asset markets. The U.S. Treasury has benefited enormously. I was doing research on this a couple of years ago, Roberto, and I know Luke Groman has also done this research on this too. That the amount of tax receipts that the U.S. Treasury is dependent on. They initially, I think, like a couple decades ago, 2 or 3 decades ago in the 1990s, it was only about 10% of the annual tax receipts were on asset prices, and we're up to about 30% now.
Yeah, it's a huge issue, and that's part of the reason why I think the Fed has become almost like a market-wide put on especially equity prices, but obviously more importantly bond prices, because they understand that an actual systemic deflation not only obviously hurts the real economy and the financial economy in the terms of the banks and the brokers who will take losses, but it actually hurts the government itself because it's so dependent now on capital gains and continual price appreciation in equities. So if you take that away, right, if you actually cause an equity price correction and maybe return to more historically normal levels, whereas right now we're in this obviously like overheated, way overvalued market where the Buffett indicator is at all-time highs, much higher than it was in 2000, 2008. Then you take away a major source of government funding at a time when the government is in desperate need of it, right? There's, Basent has been working towards this plan to institutionalize stablecoins and make sure that they become a major funder of U.S. deficits going forward. But even that's not enough because by their own calculations, they need another $1.6 trillion in net new marketable debt by the end of this year. They're running obviously 1.1 to 1.2 trillion dollars of interest expense every single year. Deficits are at 7% of GDP, about $2 trillion. And so we're in this, kind of, I guess you could call it like slow rolling crisis where the government is having to do kind of drastic measures like adopting crypto, adopting stablecoins to just find some new avenue of demand for treasury market securities, but especially bills.
Well, there's a supply and demand problem with the US Treasury market, but a lot of it is because of the interest payments on the national debt and DC spending with the budget deficits because there's no cutbacks. I mean, Trump, even to get his tax cuts for a lot of regular people, small businesses passed, look at all the votes that need to be traded and what the size of the government spending increased just to get the bill passed.
Yeah, absolutely. And again, that bill doesn't help us in the long term. It adds more to the deficits. The interest expense on the debt is really the one of the key things I look at because it's indicative of where we are and especially the debt super cycle and the debt spiral. And in May of this year, it passed interest expense officially passed defense spending as the second largest expense item on the U.S. Treasury's income statement. So the only thing more expensive than it on a yearly basis is Social Security. So if you look at the deficit again, like you have Social Security slash Medicaid, Medicare, right? Let's just call it the entitlements. You have interest expense, which is about 1.1 trillion, and then you have defense spending, which is 800 to 900 billion. And to get rid of our deficit, you need to get rid of two of the three. So we have to tell Congress you need to get rid of either, Social Security and the interest, or you need to get rid of defense and Social Security, or obviously like,
Well, they're not
interest
going to
and
get rid of it. I'll
defense.
just answer your question. They're not going to, especially the Republicans are not going to give up any of the defense military upgrades or defense upgrades. I mean, things are headed in the opposite direction, aren't they? I think they were announcing new military upgrades.
Absolutely, they are heading in the opposite direction. So that's clearly not going to be palatable for the Republicans, the boomers, who are obviously the most politically active and most, as a percent of the population, they vote like the most often, right? They're the most politically active. They're not going to accept a Social Security cut. And then interest expense, well, you have to talk to Powell for that because right now the weighted average expense on the total debt is about 3.3% and rising quickly. And the longer Powell keeps rates elevated, the higher and higher that weighted average interest on the debt moves. And that's again dangerous for a country that's 37 trillion, almost $37 trillion in debt.
So it looks like the policies, whether it's Trump, getting AMD and Nvidia, what their export licenses for GPU chips, when they have to pay a 15% royalty tax that Trump approved. Oh, you can export these GPUs to China or other countries, but you have to pay an extra 15% tax. Looks like these are out of desperation, right, to raise tax revenues any place they can with the tariffs and the other stuff. Because what Doge promised, Doge was hoping to remove $1 trillion in spending, and they didn't get anything close to that. So it's good they highlighted all this waste, fraud, corruption, and abuse. I think 4 federal government employees were already they're on trial, I think, for stealing over $500 million, but they didn't cut the $1 trillion that they were hoping to cut.
Yeah, and I released a piece called Musk Can't Fix This in May of 2025. And in that piece, I was talking about, Doge's ambitions, right? And Doge's ideals of cutting government spending, covering government waste. And I just went through the math, right? Like what Doge had cut, which was, 80 billion, 90 billion. And then on the high end, the estimates were, if you annualize like all the proposed cuts, right, 200 billion, that would be is drops that's a drop in the bucket, right? The deficit itself is $2 trillion, and so that's 10% of just the deficit. And if you want to reverse this trend, obviously you not only need to erase the whole deficit, you need to push us back into a significant surplus so we can obviously pay the interest but also pay down the overall principal of the debt. So Musk's plan, it just is simply it's not enough. Like Doge can make some cuts here and there. They can kind of take a couple paper cuts on this beast, but it's just not going to do the job. What you really need is a katana and just start cleaving off parts of the monster. But of course, that requires broader systemic reform because, like we said earlier, just the politicians do not want to have any sort of situation where there's massive fiscal cuts. Not even to mention, right, that would actually cause a recession de facto. Because cutting government spending that much, especially when we're in a high interest rate environment as we are now, would almost definitely lead to a contraction of GDP, which would, indicate at least a mild recession on the horizon.
Well, I don't know if we're going to see an official government recession, but like a lot of these S&P 500 companies, the big tech companies, they're firing a lot of six-figure employees now. So anecdotally, I mean, a lot of people that just graduated college in the last couple of years, they should have gotten high-paying six-figure jobs. They had paid internships. They're doing well there. I mean, I've heard a lot of stories where they're not getting any full-time employment offers. I just saw a story where someone graduated top of their class for computer science, had paid internships, and they didn't get a full-time job offer. They're working at Chipotle. So looks like there's industries with artificial intelligence offer that are going to be disrupted. I don't know if that'll translate to an official recession, but the government spending, the point you brought up, neither political party wants to actually cut spending. I mean, like the Republicans are like, they claim, we're pro-capitalism, we're small government. I mean, a lot of their spending's normally the exact opposite, unfortunately.
It is. It is. And another crazy fact that kind of buttresses the point that you just made is that in June of 2025, the unemployment rate for college educated males equaled for the first time ever the unemployment rate for the non-college educated males. So getting a college degree used to mean you had a lower unemployment rate, you had higher average earnings, higher lifetime overall employment time, meaning like, hours in the workforce, just because you had more jobs. And now that's no longer the case because AI and I guess you call it the agentic revolution has started to eat away at one of the few areas uh, which was profitable for college students to enter, which was software engineering. And so if that trend continues, I mean, I expect to see higher and higher unemployment, and especially like a deflationary effect on government tax receipts. Because you have to remember when a when an AI agentic company comes along and let's say, especially if they solve a problem is normally solved by humans. So let's say it does the work of an L1 and L2 coder, which is, entry level, but sophisticated enough that you generally need a degree or at least a couple boot camps under your belt to tackle. If if the AI and the agent takes away, let's say, like 50 people's jobs, not only is it obviously taking away that income from those people, it's taking away the tax revenue that was going to go to Social Security from those people working those hours. It takes away the sales tax they would have spent on food and groceries and gas and interest payments on their mortgage and tax receipts on transfer payments or gifts to friends or to an inheritance for a will, right?
Property
Like
taxes too. Yeah,
property
all the
tax. Like again, just follow this chain of logic down the road and you see every single like the government relies on monetary velocity in a large part of people actually doing things in the real economy and having to buy and sell and spend um, to earn revenue, to earn tax revenue, right? Because you go into a store and you go buy a coffee, you pay sales tax on that, at least in some states. And then the person who earns money from working at that coffee shop, they get taxed on their earnings. And then they go out and they spend money on their rent. And the landlord pays taxes on the property they own from the rent money they got. So the government's getting a cut of every single transaction that's happening in the economy. And when you take away people's ability to earn, you by default lower their monetary velocity. You make them spend less because they're earning less. And then that means that all the government tax receipts will start to fall. And so the people who say that AI is going to fix this problem, I think they have it exactly wrong. I think AI is going to exacerbate it. It's going to make it much worse.
Well, I don't think AI will fix any problems in the short term. I think there's going to be a lot of very painful creative destruction in the next couple of years. So some people will benefit. So if you're a business owner, say in another industry, and I just showed you what the graphic design I made for the thumbnail for this YouTube video, that would have cost me hundreds of dollars and probably a couple days back and forth of emails and getting rough drafts with a graphic designer. They would charge me maybe $500 in my area for a work like that. I just cranked it out with the right prompt on artificial intelligence software. I'm allowed to do a couple a day on Perplexity. I did that for free. So, I mean, like, that's deflationary for me. So, whoever takes advantage and adapts to the new technology, if you're in another industry and you could adapt to the new technology, you could potentially save yourself a lot of overhead and increase your profit margin.
Yeah, absolutely. Absolutely. So, but that this is the problem that capitalism faces, right? Is, in previous cycles of creative destruction, we were getting rid of jobs that were mundane, monotonous, but there's always a replacement job. And now we're getting to the area where we're going to have to envision an entirely new economy because all those software engineers, especially the low level ones where their work is easily automatable, or if you're a law clerk, or if you are a researcher, you're suddenly competing with an AI that can read thousands of documents a second and can collate and organize and understand, analyze, especially like, numerical information much faster and better than you ever could.
Yep.
So those hard skill jobs, those hard math skill jobs, I think they're going to get taken away first, and then obviously, what's going to be more protected is either blue collar or soft skill people jobs like healthcare, nursing, elder care, plumbing, electrician. Those kinds of things will remain protected for at least for a while.
Until the humanoid robots for a lot of the manufacturing or some of the other stuff, because those are the software from the artificial intelligence software is going to go into the robots. So the robots are starting to get enormous improvements in China Unitree and Boston Dynamics here in the US and Tesla's Optimus. So those robots, and I think there's one other company, I can't remember, it's Futurism or something like that. Brett Hancock, I think, is the CEO. I've seen him on tech podcasts. So those things are also starting to accelerate rapidly. The artificial intelligence software, Roberto, it's going to start disrupting anything with a database. So like the average human there that was in data analytics research, like you said, paralegal work, because when I was in law school in the past, like you weren't when they were teaching legal research, you weren't allowed to go use the legal databases on the websites. They wanted us to go through the books and the stacks, but artificial intelligence software can go through these databases in a matter of minutes. It can pull out research reports. You were an investment banker. I mean, like a lot of the work for an investment initial public offering prospectus. The CEO of Goldman Sachs just said that AI software can do it in an hour. A team of junior investment bankers used to take 6 to 8 weeks for an IPO.
Absolutely, yeah. And that's again, that's the danger we're facing because you lay off those 6 to 8 workers and suddenly the tax revenue collapses because now all their earnings go away. And what are they going to do? What are those people going to go and do now with the set of skills that they have? Now those skills are basically completely useless, or at least not useless, but they're so expensive, especially in comparison to the AI. So I think we have a new future to look forward to, and if people don't adapt, I think we're gonna see some maybe even social unrest here. I don't see how you can have 25% youth unemployment and basically no prospects for college educated young men and not have people up in arms and angry about this.
I think that's an important dynamic that you're highlighting here because the technology, the creative destruction, that's deflationary in a lot of aspects but the currency debasement by the governments and the asset price inflation for the tax receipts and the other reasons very, very inflationary. So you have two major forces: inflation from the governments, the currency debasement. They don't want to cut back on their government spending and the other social programs, or the just maintaining the infrastructure of the government, versus the creative destruction from the new technologies, which is deflationary. And these things are fighting each other right now.
They are, but again, I think I always go back to that Hindenburg research piece that they did, analyzing like the 55 market economies who faced 120% debt to GDP in the last 150 years. And they found that 54 out of the 55 chose either inflation, hyperinflation, um, monetary restandardization, meaning like they just got rid of the old money and created new money. Um, and then one didn't choose the path, and that was Japan. And Japan is currently still in the midst of, I would say, a burgeoning crisis in the yen, as well as a burgeoning crisis in the 30-year and 40-year bonds. If you look at the 40-year, it's at all-time highs at 3.3%. The 30-year is at about 3%. There's been talks of a couple major Japanese banks, including Norin Chikan, and I'm probably butchering that, having insolvency issues as related to their JGB holdings being underwater, as well as some other of their more private Japanese debt holdings. But there's truly no way to square this hole, right? And that means that the only answer really that the central banks have at the end of the day is money printing, is more debasement. It's just the question of what form it takes. Because as we've seen since 2020, the monetary system has evolved to the point where they can create liquidity, they can add liquidity without on paper increasing the balance sheet. So they can use the BTFP, they can use reverse repo, the TGA, they can change the SLR ratios, they can change the other capital ratios, they can stuff more money into money market funds and have those buy treasury bills. They can do the same thing with stable coins. So there's a lot of options actually a lot of levers for them to pull. The question is which ones they're going to and how much time that's actually gonna buy them.
So you brought up Norinchukin Bank. There's a lot of Japanese banks, and they actually bought older U.S. Treasury bonds. So not only do they have problems with the JGBs, Japanese government bonds, like you said, they also have problems with older U.S. Treasury bonds. So that's an issue. And I think the one asset class that I'm not confident in that's going to do well are these government bonds, whether it's U.S. Treasuries, longer duration ones. You're seeing that in the behavior with people like Warren Buffett that have an enormous amount of cash, with Berkshire Hathaway and others. Like in the past, they would have parked a lot more cash in what longer duration treasury bonds to earn a quote unquote risk free higher interest rate. A lot of the smartest investors are not buying longer duration US treasuries. It looks like the one asset class that's kind of the one I would stay away from, that I think is toxic or radioactive, are government bonds at this point, especially longer duration ones.
I totally agree. And actually, so I released a piece this must have been April or late March of this year, as well as I released a piece about this last year called The Quiet Pivot. But I talked about how if you actually look at the Fed's balance sheet, right, and you break down their treasury holdings by maturity, and then you stack it for year over year change, you see a really shocking chart. And if you go on my Twitter account and search Banana Republic, it should be one of the first tweets that come up. And in this chart, you see obviously an explosion of growth in all maturities as the Fed starts QE in 2020, and a peak in late 2021, and then obviously as they start the taper in 2022, the balance sheet starts to reduce. But if you look closely, you'll notice that the yellow bars on the chart never go negative, so they never move negative over year, and those yellow bars represent any bonds past 10 years. So it's 10-year, 20-year, and 30-year long bonds, U.S. Treasury bonds held by the Federal Reserve. So the Fed itself found that it couldn't fully taper the long end of the curve without, likely causing treasury market dysfunction. And given that that's the part of weakest demand, it makes sense that they would elect not to taper those long bonds. Instead, they compensated by tapering more bills and more 2-year and 5-year notes. So what that indicates to me is that they're also understanding that they're facing a bond crisis, and that these instruments are becoming more and more toxic, and especially as inflation remains elevated, right? The core CPI last month came up at 3.1%. Overall CPI is at like 2.7. The ex food and gas is at the highest it's been in a year, month over month. All those are indicating to me that inflation is not slain despite the high Fed funds rate. And especially if the Fed starts to cut, inflation is going to roar back in a meaningful way. And obviously, as we know, given the convexity of the longer bonds, that's going to cause the long bonds to drop even more in value at a point where TLT is, already down 50% on a 5-year basis. That could see more bloodshed here in the coming quarters.
Well, a lot of bond fund managers blew up. I mean, on financial Twitter, there's a ton of bond fund managers that just shut down their bond fund quietly and opened up new bond funds. I won't name names. There's around half a dozen. One of them a couple years ago told me they lost $1 billion in their stock market on their bond fund, older U.S. Treasury one, and they were still growing their stock market one. So they offset all the losses because they were paying the right financial YouTube channel to not talk about and going on business TV all the time and not talking about all their older U.S. Treasury losses. So I mean, like, there's a ton of, like, let's just say, enormous losses. Whether it's U.S. banks, Japanese banks, the holders of those older U.S. Treasuries are in. I think there's an enormous amount of losses. They're gonna probably just gonna change the mark to market accounting rules. They probably all just ignore them.
Yeah, honestly, but papering over the losses or ignoring them or shoving them, under the rug isn't going to fix the fundamental problem. And the fundamental problem is what Darius Dale pointed out in a Macro Voices interview a few weeks ago, which is look at just the supply and demand for US Treasuries. And it's been reducing ever since the taper began. Obviously, it's been reducing as interest rates have gone higher, and especially on the long end. And that marginal supply and demand is what sets prices. And so if we see an increasing deadening, I guess you could say, of the long bonds, we see increasing reductions in liquidity. That means volatility increases de facto, and that likely spurs more quantitative easing from the Fed because they'll have to run yield curve control, especially in the long run, eventually, in order to keep the yields capped on those long bonds, just because no one will want to own them.
Well, the Fed isn't doing officially balance sheet expansion, quantitative easing, or debt monetization yet, right? So it's the Treasury that's doing buybacks or something like that. Didn't they increase the amount of buybacks recently? But I think Janet Yellen, when she was Treasury Secretary for the last, up until recently, but over the last like 4 or 5 years, I mean, she did a lot of shenanigans with the short term debt financing to allow the previous administration, the Biden administration, and Congress to spend like crazy in the short term. Just insane. I think the U.S. federal government was spending right before Janet Yellen left as Treasury Secretary. The annualized pace was like $8 trillion a year. It was a insane amount.
Yeah, it was excessive. And she was shifting again. If you look at the QRAs, the quarterly refunding announcements from the Treasury, she was shifting issuance from the long end of the curve to the short end. I did a report about this in I think it was October 2023 when Yellen was still in office, and she had shifted something like 2 or 3 billion in each maturity in monthly issuance, or no, sorry, I think it was weekly issuance for each long end maturity towards the front end. And she had done that also in June of 2023 in the June QRA. So like cumulatively it adds up to, hundreds of billions of dollars a year moving to the short end, to the bills, to the 1 year, and then obviously like the 3 month bills. And that means that, she understands this fundamental issue that the long bonds just do not have enough demand, and there's going to be a yield, or you can call it like you know, a bear crisis in the bond market if they allow the normalized levels of bond issuance on the long end. So since they can't do that, they can do these treasury, you call it TQE. That's what Concordanomics calls it. It's treasury quantitative easing. Shifting to the short end is one way. Doing buybacks is another. If the Fed value bonds at par, that's another way to do kind of like a quasi QE. But there's a lot of different things they can do. They could regulate the banks to even, force them to buy more long bonds. So another way they could do it without directly involving the Fed. But all these are just symptomatic that the U.S. is continuing its path down this sovereign debt crisis.
Well, also DC's not going to cut spending, so I mean they could it's kind of rearranging deck chairs on the Titanic. Like they could change the accounting laws and the SLR, like you said, and just go from 10% reserve requirements of treasuries for the commercial banks here in the U.S. up to 20 or 30%, which Jamie Dimon has said they shouldn't do. But the main issue here, and this goes back to the supply and demand issue with treasuries that you pointed out, and I've been saying for the last couple of years that we'd eventually get to this point, is that the largest buyers in the past of treasuries for what the last couple of decades were China, were Japan, a lot of the US's other countries, foreign central banks. They are not net buyers of treasuries, and they are buying gold. So I'm not a huge fan of US treasuries. I'm staying away from those. I know a lot of traders are looking at what short-term treasuries for a rally, a dollar, that the dollar is going to bottom soon and the dollar is going to rally. But it just seems that what President Trump and the Treasury Secretary Scott Bessent, they don't want a strong dollar. Would you agree that they don't want a strong dollar?
Yeah, they don't. I mean, it if you're trying to increase dollar funding, especially from sources that are using foreign capital, you do not want a strong dollar just because it makes the foreign treasuries, marginally more expensive. So, their plan to weaken the dollar makes sense from that perspective. And Besant's issue, like I mentioned earlier, Besant, one of his main points has been to push stablecoin dominance. Not only in the domestic banks, create standardized rules, create, I guess you could call like institutional capital pools that will be able to use stablecoins to transact. But he also wants other countries to adopt US dollar stablecoins, specifically, USDC. And so that means that, the stablecoin market can start to swallow. And he estimates, I think, like it's like 2.2 trillion in the next 5 years and up to 3.4 trillion of net new bill issuance can be swallowed by the stablecoin market if it grows at an appropriate pace. And that can help to buttress the issue that the US is facing. But it would, again, it doesn't solve the problem. The debt growth outpaces even the demand and the new demand sources that they're finding, like stablecoins.
Well, also, if President Trump and the other people in his administration are going to threaten Russia sanctions and increasing sanctions more or put tariffs on trade partners, that's not putting any type of incentive program in place for any trade partners to recycle their trade surpluses and buy more treasuries. So then you're going to exacerbate the problem. Anyone who is holding a lot of treasuries is going to be thinking about selling more. And people who are thinking about buying treasuries, other foreign central banks outside the G7, they're not going to want to buy more treasuries either if you're threatening, all the time sanctions or tariffs or things like that.
Yeah, exactly.
And now here we're back to then types of macro strategy then for investment. Then it sounds like you just laid out the case for the stablecoin, why Bitcoin probably is going to end up going higher in the next couple of years, and then also for gold. Those seem like really good macro trades based on the policies.
I would totally agree. And another thing I'd add is, something I've been tracking very closely is the yen carry trade. If you look at the dollar yen, USD JPY, it broke 150 in July. It's now back below 150, but it's still near the red line. The BOJ has switched now from being a pure play, intervention maxi, where they were throwing billions of dollars at the market every single month in September 2022, and then again in, May and June of 2024, and even July. They've switched from that kind of hardcore monetary easing dovish stance to a more flexible, let rates rise and let the cards fall where they may and turn off yield curve control stance. But the problem is obviously now the bond market is starting to take the brunt of the beating. Like I mentioned earlier, both the 30-year and 40-year bonds are past 3%. And we may not think that that's much, right? Because we have not a reasonable, but a relatively lower level of GDP of debt to GDP. But the Japanese are at 263% public debt to GDP. And under those conditions, 3% is actually a lot, right? That's something like 7%, 7.5% of if all the Japanese public debt got repriced at that level, they'd be paying something like 7.5% of their GDP in interest expense alone every single year. And so that would be double our interest expense right now in relative terms.
Is it
So
true that like a 100 basis point increase in interest rates in Japan would wipe out like all their tax receipts? It would just go to interest payments. So I think I saw a statistic a couple years ago where if interest rates went up like 1%, it would wipe out almost all their tax receipts just on interest payments.
yeah, I mean, I'd have to do the math, but that sounds roughly correct. Again, their issue is they're facing this, dual monster of extremely high debt loads, but also higher interest rates abroad, which is drawing capital from the US from the Japanese markets into the US. So for years, especially since 2022, when the Fed started their hiking cycle and the Bank of Japan stayed at the zero bound, all these carry traders were going to Japan, borrowing hundreds of millions of yen or hundreds of billions of yen, and then siphoning that money into, the forex markets, selling yen, buying dollars, and then transferring the dollars to U.S. bank accounts and buying U.S. Treasuries. And that, especially if you hedge the currency trade, which maybe takes, 50 basis points off the return, that's 4.5% of basically free money, right? Especially if you're invested in short-term treasury bills. Like the treasury's not going to default. So um, that became a very popular trade, and that's why the yen devalued 35% in the last few years. And that's why it still remains at a very weak level, right? At about the 150 handle, 148. And so if this trend continues, which I expect it to, they can buy some time by letting the bonds, blow up and start to release some of the steam from the pressure that's building in their economy. But long term, the bonds blowing out is actually in many ways worse, especially for the Japanese policymakers and for the government than the currency. So I expect the BOJ to, either reinstate yield curve control at 3% and just commit to buy, more bonds, which would cause the currency to devalue, or just even do outright QE and bring yields back down to zero, especially once the Fed starts easing again. And once that happens, again, look out below for dollar yen.
Well, it sounds like no good options left for the Bank of Japan, and they basically got into the end game where there's no way to avoid the pain. That they've managed to delay the pain, for decades, over 3 decades, because that was the widowmaker trade where people kept like, oh, the Japanese government bond market's going to blow up, oh, the Japanese yen is going to be massively devalued, and for over 3 decades, it actually just never happened. Well, now a lot of these Japanese banks, you mentioned Norinchukin, a lot of these other Japanese banks have massive losses on older bonds. I mean, the market hasn't figured out that they have losses on older US Treasury bonds too, because they were doing a lot of leverage trades on those as well. So there's a lot of losses on these older US Treasury bonds, the longer duration stuff. And it's not just US banks that have the losses. So, like, you had the Silicon Valley Bank incident, but there's a lot of foreign banks that also have the losses too.
No, absolutely. It's a worldwide issue. And Norin Shikan is not the first and not the only one. Nomura has significant losses, right? You look at Mitsuo. There's the Mitsubishi Financial, which is basically like Mitsubishi's financial arm. Like there's all these other banks that definitely have losses and issues, but what the Japanese system has done so effectively, and what the rest of the world learned from Japan, is how to paper over those losses with 0% interest rates and QE infinity. And when you have those two factors in your economy, you're able to zombify companies, right? They can borrow debt forever at 0% and just roll losses forward into the future, into the future, into the future. But the Bank of Japan finally had to meet their maker in 2022 and 2023 as the Fed started hiking, and finally this perpetual motion machine of QE infinity and negative rates started to come to a halt. And that just again it proves to me that financial gravity cannot be avoided forever. Of course, you can do things to kick the can. Some of the more alarmist yen bears were wrong, not in direction, but in timing, in the sense that they thought that the BOJ couldn't put this thing off for a decade or 2 decades, and they were able to. But, eventually the financial gravity and the laws of economics come for everybody, and the Japanese are no exception.
Roberto, it sounds like the average person out there should not want to hold currency for a long period of time. So Japanese yen, euro, British pound, Chinese yuan, US dollar, Australian dollar, Canadian dollar. It sounds like all these governments and central banks, they're all intentionally trying to devalue this. So if you hold these currencies for, say, a couple years over time, you're going to get your purchasing power destroyed.
I agree, totally. And remember again, like if you're in these, especially these higher risk countries like China or Japan, you're going to have there's a higher risk and higher chance of that happening sooner rather than later. But this is coming to every developed country. I mean, of the G20 countries, something like 75%, 80% of them are above that 120% red line that we talked about earlier from Hindenburg Research. And so, again, if you're in any of these countries, you're in the Eurozone, you need to think about ways you can protect your wealth against debasement. And I think gold and Bitcoin are the best ways to do that. I mean, just last week, the gold front month gold futures passed 3,500 for the first time in history. And I don't expect that that this rally is going to end anytime soon. The fundamental demand story from China still remains strong, despite the fact that the Chinese have, committed to basically like a slow motion deflationary collapse of their housing and shadow banking bubble. Capital continues to flee China, or at least flee like the traditional stock and bond markets and move into gold. So the Chinese demand story is very strong. We're seeing, obviously, like you said, central banks, Poland, India, um, PBOC, like all these banks are buying record amounts of gold every single year. 2024 Q1 was a record. 2025 as well. The first 2 months had the highest amount of gold imports into the US, the highest amounts of withdrawals from the LBMA, which caused obviously this, kind of lineup crisis at the LBMA where banks and authorized participants were waiting weeks and weeks and weeks to get gold deliveries. And these are all just tremors showing that the system is breaking slowly. And if you don't have gold and you don't have Bitcoin, you're going to be left in the dust.
And you could be selective about the other commodities too as an inflation hedge, but then some of them are more subjected to investment from other industries or the real economy actually doing well. So like I think like natural gas has crashed a lot lately. Natural gas from risk reward as a contrarian, natural gas is looking interesting to me. I was talking about platinum and palladium over the last couple of years. It was cheap and hated. It was in a bear market, I think, for the last 3 or 4 years to the rally the last 6 months. You've had a nice rally in platinum and palladium. Silver price is still above 35, well above $35 an ounce. So you are starting to see rallies. These commodities that are cheap and hated, they don't stay cheap and hated forever. I know I've known you for years now. Remember when uranium was cheap and hated back then? Now everyone's talking about nuclear power for the data centers, and we have to start investing in Google's investing in research and development for nuclear fusion, and like it's nonstop, basically press releases about which countries can invest in new types of nuclear power or build nuclear power plants fast enough for the data centers.
Yeah, and actually I had this guy Stormy Waters, who's a VC, one of the smartest investors I've ever met, on my podcast back in 2024, and he was pointing out this uranium story, and he said, look, like from all these hedge fund managers and all these, high net worth investors I talked to, uranium seems to be one of the best plays. And yeah, you look at uranium ETFs and they've absolutely skyrocketed. They've performed extremely, extremely well. It's been a great trade. And you think about all the information not only, not only needed for the servers that run the AI models, but also just the compute power needed to just run the actual core computation. You're looking at a ton of energy costs coming up in the future. And all these data centers that are going to be built need capital, they need construction, and then they need electricity for decades in order to run properly, and cooling systems, obviously. So there's just going to be more demand for electricity, for clean energy in the future. And I think uranium is an example of a great play you can make. Obviously, also copper and silver and these other adjacent minerals are also needed in the production process. So I think you're going to see a bid in commodities across the board.
Well, natural gas is out of favor right now, but I could tell you a lot of the data centers in the United States and Russia is talking about building massive data centers. They have cheap natural gas. You have the United Arab Emirates, which has cheap natural gas. They're talking about building. I think they're contracting with OpenAI to build the Stargate data centers there too. So you're going to start to see not only nuclear power and uranium, which is clearly in a bull market in my opinion, but I think natural gas is also going to benefit from this because the data centers in the U.S. we have cheap natural gas here. All they have to do is build a pipeline from the cheap natural gas production up to the data center. We're going to see that with the Stargate AI project in Texas, Elon Musk's Colossus data center in Tennessee, the XAI ones, which are unbelievably large. I think over 100,000 GPU units in one. I think they're almost at 200,000 in one of them, and they're planning even larger than that in the next 5 to 6. I think for 5 to 7 years, they want to get up to a million GPUs in one of the data sets. That's like an absolutely insane amount of energy usage.
Yeah, I know. It is insane. And that again, that just is more energy, or more, I guess you could say, like, bullish argument for the energy sector. And so I think uranium, natural gas, again, all headed higher here in the long term. Short term, obviously, we're still facing this kind of uncertainty as Trump is set to meet in I think it's August 15th, right? Yeah, in 3 days on Friday, with Putin in Alaska. And it sounds like they may be trying to come to a ceasefire agreement, including land secession, or secessions from Ukraine to Russia, which would potentially mean that Russian crude would come back on the market. And obviously, we saw a huge dislocation in the crude price when this potential meetup was announced because traders were expecting, hey, if this thing goes through, we could see much more supply in the market and crude prices will be depressed significantly because of the increased supply. So we still have a bunch of uncertainty to deal with in the short term, but long term, you're absolutely right.
Well, we're seeing a consolidation, mergers and acquisitions in the oil and natural gas space. So you're starting to see selective acquisitions. There's rumors that BP is up for sale. So you have three large companies, Royal Dutch Shell, Chevron, and ExxonMobil, potentially rumors of all three looking at buying them. I never thought, I was an oil analyst many years ago. I never thought at a newsletter company that I would see BP up for sale, potentially being bought. So you're starting to see that the industry is going through, they're getting leaner and meaner, typical bear market behavior right now. So they will eventually, the cycle will turn. They'll become more efficient. They'll focus on cutting overhead and cutting costs. So the cycle will turn at some point. I want to ask you though, because these energy prices are relatively weak right now. I want to ask you about gold stocks. Talk about gold stocks. You were talking a couple years ago about timing them, and the timing was bad. That was because the energy prices were rising, even though the gold price was rallying too, but the energy prices were also rising. Are we potentially in the best, like the sweet spot, like a huge tailwind bull market now for the gold stocks, where the metals prices are high and the energy prices are weak, and we could see prolonged outperformance and free cash flow for the gold stocks?
Absolutely. I think we are. Again, I mentioned to you off air, like 2022 was a rough year. I was heavily invested in gold stocks. And after all these sanctions were announced in Russia in response to their invasion of Ukraine in 2020, in February of 2022, energy prices, of course, across the board started to surge. And at the time, I hadn't realized how impactful a higher energy price would be to the miners because the miners use obviously diesel fuel for all the excavating equipment. They use trucks and other methods of moving the ore to refineries. The refineries are extremely energy intensive, and the entire production process just uses a ton of CO2 in the form of emissions, but mainly obviously energy, mostly natural gas, but obviously also crude and other forms of energy for actual refinement and processing of gold and silver. And so I didn't understand how quickly the margins would decrease and how rough, even though the gold price might go up nominally, how rough the financial picture would look for the miners. But we're now at a point where, if this Russia-Ukraine war is winding down, if the sanctions are coming off board, and if energy overall is going to remain cheap and gold continues to climb higher because of the Chinese demand picture, I mean, it is definitely, like you said, it's like the doldrums, the sweet spot for um, the golden spot for gold. It's what I would call the golden bull market because you have the same time falling energy prices as you have gold prices soaring to levels that they've never seen at literally every single month. I mean, I don't know about you, dude, but I haven't seen a gold market that's been this consistent in my entire lifetime. And
Well,
you have to
this
go
is
back to like the 70s to see something like this.
Well, Roberto, this is a scenario that the whole gold community had been predicting for the last 15 or 20 years. It just took many years too long.
Yeah.
But to add to your points there, you mentioned in 2021, 2022 how the energy price spike and the energy prices went bonkers for about 14, 15 months in 2021 and then peaked around early 2022 with the Russia sanctions. And then Biden flooded the market with SPR oil, and then he went crazy, like negotiating with Iran and Venezuela, like removing all their sanctions to get oil imported here in the United States. But I remember 2011 because I've been doing this so long, and then I was interviewing Rick Roll then at the time too. I mean, back then the gold price hit 1900 for the first time, but what the average person didn't realize is all the mining companies' costs, because they were so inefficient, were rising faster than the metals prices. So like they were overpaying for like truck tires on those massive earth mover equipment stuff, and their energy prices were going bonkers. They just could not control their costs at all. So all their profit margins and the free cash flow the market was expecting in 2011, just wasn't there, despite gold prices going from 1,000 to 1,900 in I think under 14 months. So you have to be careful with the mine. That's like the thing here with the miners. You have to be careful. This is why, as a royalty company investor, if you buy a royalty, and I've owned Wheaton Precious Metal shares since 2011, if you buy these companies at the right price, I mean, you don't have to worry about any of this stuff. But the mining companies like a Hecla Mining that I think you talked about I mean, if their costs, their profit margins could go out of control quickly if they're not careful.
Yeah, exactly. And so it takes, again, it takes a different sort of investor to understand those risks and to understand especially the executive makeup of each company. Because some of these, right, some of these executives have been through a gold bull market and they know how to operate a gold miner in that scenario. They also have been through bear markets, obviously, and know how to operate in that scenario. But if they haven't been versed in both those worlds, then they run a risk of what you said, running the business inefficiently, and that can cause price underperformance. And by the way, this is not, unique to even just the gold market or even just the silver market. If you take a look at the Bitcoin miners, there's a Bitcoin miner ETF. I think it's called WAGMI. We're gonna make it, or WGMI. And Caleb Franzen, who's another macro analyst, stock analyst, pointed out in 2024 that if you divide that Bitcoin miner ETF by Bitcoin, it's been trending down ever since 2022. So the miners have been consistently, as a group, have been consistently underperforming Bitcoin itself, just because the miners have been making these strategic errors, making mistakes, not understanding their energy costs, not understanding, downtime and uptime with their mining rigs. And there are a few Bitcoin miners you can point out that have outperformed, that have done really well on certain time periods. And again, if you pick those, then it's brilliant, good for you. But you just have to be careful because there's so many that will just underperform. And so that's why for both gold and Bitcoin, obviously if you're a seasoned investor, go take a look at the miners. But if you're a retail investor just getting started, I would just advise to buy the underlying commodity, buy the Bitcoin, buy the gold, buy the silver, and worry about the miners later.
Isn't that the Bitcoin miners, did they have to move out of China before 2022? So that was years ago when they had to move, because it seems that isn't the way the Bitcoin protocol is designed with the blockchain and solving the difficult math problems there, that every couple years when there's a Bitcoin halving, the miners cost rises even more.
Yeah, so whenever there's a Bitcoin halving, it's not that the cost rises necessarily, it's that their revenue falls immediately because they get as half as many coins per successfully solved block as they did before. And when China banned Bitcoin in 2022, the hash rate obviously fell by like 35-40% within the space of weeks, right? It absolutely collapsed. But within about, you know, 12 to 18 weeks, it recovered back to baseline and then it started to continue to grow from there. And if you look at the hash rate now, it's hitting all-time highs about every 2 or 3 weeks. So it'll cycle up, hit an all-time high, then cycle back down 1 or 2%, stay below that, and then start to rip a little higher. And so the overall network capacity is more than it's ever been right now. And the difficulty of solving the problem obviously has increased because there's more hash rate on the network and there's more compute power. So one of the Bitcoin's genius inventions was the difficulty adjustment, which means that every 2 weeks, a calculation is done to calculate the overall compute power of the network, and the difficulty of the math problem either increases or decreases based on the overall compute power of the network. And so if the compute power goes down, then the problem gets easier, and then vice versa. So the system adapts and is almost like anti-fragile in that sense.
Are we seeing more emerging market countries announce that they're going to be adding Bitcoin reserves? So are we seeing like some of these emerging market countries announce that they're diversifying, so they're getting away from treasury bonds, they're adding a couple tons a month of gold, and they're also buying Bitcoin? Are we seeing more of that?
So on the nation state level, it's been pretty limited. You look at basically the only three countries are El Salvador, the Democratic Republic of the Congo that's adopted Bitcoin as legal tender, and then I know that Bhutan, they have a sovereign wealth fund, and they've been doing not only obviously buying Bitcoin outright, but they've actually been doing Bitcoin mining, and I believe they've been using energy from their geothermal vents to do that. But on the nation state level, those are really only the three main actors. Obviously, we have the potential for the US to become a bigger actor if they announce a strategic Bitcoin reserve. But so far, that's just kind of been, I think Senator Cynthia Lummis uh, like started the bill in the House about a week or two ago, but I don't know if it's going to get anywhere because like as much as Trump talked about Bitcoin and as much as some of these senators will pound the table, I don't know if there's enough appetite in Congress to pass a Bitcoin reserve bill. Now, if they pass a modified version of it, which would move the current Bitcoin holdings that the US has, which is about 400,000 Bitcoin, into like a strategic reserve that isn't touched, then that would protect the Bitcoin held by the DO that's been seized by the DOJ from criminal enforcements like against Silk Road into a segregated account where it can be held as like an asset for the US Treasury. But if even if that happens, like people need to realize that that won't change the fundamental supply demand picture for Bitcoin because all that means is that the ownership of the coins is being passed from the DOJ and subsequent regulatory or law enforcement agencies to the U.S. Treasury and designated in official Bitcoin wallets that are held and protected and secured by the U.S. government. That doesn't mean that the U.S. government will necessarily buy. Now, if they do a larger bill, which indicates Bitcoin buys, which is what Cynthia Lummis has proposed, which is 1 million Bitcoin over 5 years, then obviously that would add buy pressure to Bitcoin price. But if they just did this strategic reserve, the SR, it would just mean that the Bitcoin's more secured and that obviously that there's finally a nation state level actor who holds Bitcoin but not necessarily is buying any.
Okay, so there's not net purchases. So this Bitcoin strategic reserve proposal that Trump has talked about really since before the election, it's not net new purchases then. Okay.
No, it's not. At least as far as when I've gone back and watched his speeches or understood what he's been saying. If you look at his speech in Nashville in 2024, for example, he didn't mention actually purchasing any. He mentioned moving the coins held by the DOJ and the other law enforcement agencies into a segregated account held by the Treasury, which will be basically become an asset held on the Treasury's balance sheet. So basically, like officially move it into government custody rather than have it displayed over 15 different agencies. Because right now, all those coins are held, the FBI has one wallet from, Silk Road with 80,000 coins. And then they have another wallet from, Quadriga X, which is another exchange that was hacked, that they seized from the hackers and it has, 50,000 coins. And they have all these little wallets all over the place that are just add up to 400,000 coins in total, but none of it's officially, put into a specific place for safekeeping or officially put into a specific address for, for listing as a government treasury asset. And so if the DOJ, for example, wanted to return those funds or, just dump the Bitcoin or whatever, they could technically do it. And so doing the strategic Bitcoin reserve that Trump recommended would put it under official treasury control, which would obviously need the Secretary of Treasury to sign off on any movements of the coins. But Cynthia Lummis, Senator Cynthia Lummis, I believe from it's either Montana or maybe Michigan. It's one of the Midwestern states. She is proposing a larger vision of the Bitcoin reserve, which would be buying 200,000 to 250,000 coins a year for 4 to 5 years. So she wants a total of 1 million coins.
I've heard someone talk about putting those bitcoins that are already like in those different accounts into a sovereign wealth fund too. I've heard like putting stuff into a sovereign wealth fund that Trump wanted a sovereign wealth fund with a bunch of investments into there. So I don't know. We'll see what ends up happening. It's too early to tell, I guess.
Yeah, it is.
Well, I mean, for the gold stocks, I mean, that's one of the only industries, though, Roberto, where there's actually free cash flow growth. I would argue probably the most free cash flow growth because a lot of the other industries, it looks like these other companies, the industries, they're cutting back, they're firing, they're reducing capital expenditure, other than the tech companies, which are spending like crazy, what, on the data centers and artificial intelligence. It looks like they're in an arms race. A lot of these other industries, in the SP 500 doesn't look like they're in bull markets and free cash flow growth. So the index has gone up, but the majority of the index going up, what is capital flows into the US and the Mag 7.
Yeah, and if you look at there's a chart that was circulating Twitter the other day that shows the increasing disconnection of the Mag 7 and the rest of the stock market. And we see just like what I mentioned earlier, if you have the MSCI and you exclude the US, like 80% of stock market gains are gone. Because the US is driving most of global growth. The same is true for the Mag 7. If you exclude the Mag 7, it's not as extreme, but something like 65% of all stock market gains for the last few years are already gone. And that's just if you exclude Nvidia, Apple, Google. Facebook, those big tech companies. So
And they're
um,
also spending the majority of the capex too. I think like 35% of all the capex being spent is the Mag 7 companies with the free cash flow that they're spending on what data centers and the tech upgrades with AI or robots. So they're the ones spending the majority of the actual capital into the real economy too.
yeah, exactly. Exactly.
It's creating a lot of mess and distortions. I mean, if for those out there that are looking for a full-time job, I mean, you got to go where the capital's invested. I think there's going to be gold mining jobs available too.
Absolutely. I think there will be. And like I said, this just like how Lynn Alden says nothing stops this train with regards to the debt, I think nothing stops this train with regards to the gold market. We're seeing, like I said, month over month, consistent price increases. We're seeing demand shortages or sorry, supply shortages in the LBMA earlier this year. We also are seeing obviously strong demand from China, like I mentioned, very strong demand from the central banks. And given where the US is headed on the fiscal and monetary side, I don't think this trend is going to stop anytime soon.
Well, not only the budget deficits and the interest payments and how quickly the debt's growing, you also have what President Trump and his administration threatening sanctions or tariffs on trade partners or allies. So if they keep doing that, and we've seen this with the Russia sanctions over 3 years ago, starting from February 2022 with the Russia sanctions, I mean, the other countries saw what happened to Russia with the sanctions, and the amount of gold purchases each month by the non G7, the BRICS countries, have basically doubled each month from over the last 3 years post Russia sanctions.
Yeah, yeah. So I think if you're supposed to be looking at the miners, now is an attractive time to start hunting for some names. And even a lot of them, again, like their free cash flows are growing so rapidly that it just makes sense. I saw Hecla Mining pop like 17% the other day. I don't even know on what news, but I no longer follow the space as closely as I used to. But if you're looking for an inflation hedge, I think that's a great place to start looking.
Yeah, but you have to be careful with individual miners because Barrick Gold just announced earnings and their cost ballooned to 1,700, and people were upset that they didn't hit the numbers on the free cash flow. So whereas companies like Newmont Mining, Newmont beat a lot on the free cash flow expectations. I think the Wall Street analysts were only expecting under 700 million of free cash flow for the quarter, and they beat by over $1 billion. I think it was 1.7 billion of free cash flow and Agnico Eagle. So you have to be careful if you're picking out individual mining companies. Also, the other issue, and we've seen this with Sandstorm Gold, which is a royalty company. I mean, like if this larger company has free cash flow, they're going to go look and buying assets cheap. So your upside is going to get capped then with mergers and acquisitions. So the company that has more free cash flow, better profit margins, they're going to go look to go buy more growth if they think that assets are undervalued. So you're going to see more mergers and acquisitions in the space.
Yeah, absolutely.
Well, I want to thank you so much for your time today, Roberto. I really enjoyed it. Keep up the excellent work.
Yeah, thanks for having me on. I really appreciate the invite.
And plug your Substack again.
Sure. So, okay, on Twitter, I go by Peruvian_Bull, although I recently, shared my name, which is Roberto Rios. I also have a YouTube channel, which is under the same name, Roberto Rios / Peruvian Bull. And then my Substack is endgame.substack.com. You can go there and subscribe for more, in-depth macro research, more in-depth, stock. I occasionally do stocks breakdowns, but mostly just global macro stuff.